Welcome to Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here is your host, Anette, Talie.
Welcome to another episode of Deal Closers. I am your host, Anette, Talie, and my guest today is Yonah Weiss. Welcome, Yonah.
Hello, Anette. Thank you very much for having me.
I'm very excited to have you. This is a topic today. We're going to talk about cost segregation. And this is a topic that I'm so excited to learn about because I have a 6-unit that I bought in Florida about a year ago. So now this is the first time that I'm going to do taxes. So I want to gauge if this is a good option for me to do cost segregation. So let me tell you a little bit about Yonah. He is a powerhouse with property owners' tax savings. As business director of Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He is a real estate investor and host of the podcast Weiss Advice. Welcome. So tell me, how did you get into investing? Because I love to get advice from investors.
So it's been really about 5 years ago. I knew almost nothing about real estate. And I was a teacher and I really wanted to learn about real estate. Really, not necessarily real estate, I wanted to do something, and I wanted to try to find it, branching out to find a different profession, something that would just, kind of bring a little income. I had a bunch of friends that were involved in real estate. And it just kind of fell in my lap, something that, I'm a lifetime learner, so I love to learn. And that's part of being a teacher. And I just want to learn everything I started learning about, bigger pockets and started learning about real estate in general. I just wanted to learn more. So I started as a commercial mortgage broker just to learn all of the ins and outs of commercial real estate. From that perspective, then I got my broker's license to learn the residential side and try to find deals, and did a few fix and flips. And that kind of was I call them fix and flops, right? Because they didn't really work out that well. And then, over the past few years, being so involved in the commercial real estate world in so many different ways and interacting and networking with people in the multifamily industry, I've just been drawn to multifamily investing and, going right now into, before this situation with the pandemic, we're looking at several deals in the Southeast, larger multifamily deals with some partners. So I'm really excited to kind of get my feet wet in, for kind of at the beginning of this new kind of page, this new chapter of multifamily investing after having learned for so many years, just jumping in.
Awesome. All right, so let's talk about cost segregation. So for people that don't know what a cost segregation is, can you please give us a little bit of a summary?
Sure, absolutely. Now, just to be, take a step back to understand what cost segregation is, we have to know what depreciation is. Because cost segregation is a weird name for just like an enhanced version of depreciating your property, which means maximizing the tax deductions that you can take, or the IRS allows you to take, because you own a commercial real estate property. And now when I say commercial, I mean anything that is not your personal residence. So that can include multifamily, it can include single family, it doesn't matter. It just means that it's not your personal residence. Because that you don't get depreciation. Now, depreciation means, by definition, something goes down in value. But from a tax perspective, it just means it's a tax deduction the IRS gives you based on the fact, or the principle rather, that things go down in value. And your property that you just paid $1 million for, let's say, based on that price that you paid for it, is now going to decrease in value, at least on paper from a tax perspective, over the next 27 and a half years. The IRS gave this kind of random number, 27 and a half years. And then if it's a commercial property, not residential, it's 39 years. So that means that you can now take a tax write-off deduct from your income taxes straight away every single year for the next 27.5 years, a small amount, and that's called depreciation. Okay, that's a deduction that IRS gives you straight in your tax return. Deduct that right away from your income, and then you only tax on the remaining amount. Cost segregation is breaking down or segregating that cost of the building that you just bought into different categories that actually depreciate at faster lives. So if you want to, just for a couple examples, things in the building, the main structure may depreciate at a much longer life, at 27.5 years, but things like furniture and fixtures and appliances and things that are movable property actually depreciate on a 5-year schedule, which means if you can determine the cost or the value of those individual assets, you can now write those off at a much faster life. In a nutshell, that's what cost segregation is. Breaking down, segregating out the costs, and taking those, kind of segregating out the depreciation deductions into different years, different lives.
Awesome. And can anybody do cost segregation, and if this is a specialty?
Yeah, I mean, anyone can do it. It requires a professional, requires an engineer. The IRS has a requirement that engineers actually need to come to the property. There's a huge list of things the IRS requires to have a quality cost segregation study done. So it can't be done by anyone. Anyone can take advantage of it, but even though it's an accounting method, even accountants can't do it, because it requires that engineering, requires firms that specialize in this to do this.
So these engineers have like a special certification?
It's not a certification per se, but it's just the experience and the expertise in the tax code and in the engineering of the property.
Awesome. So let's talk about a real example, like so people can understand. Let's say you buy a building for $1 million, and like talk to me with numbers. Like what can a cost segregation do for, like, let's say a $1 million building?
Okay, so let's break it down, right? You have $1 million building, right? So the first thing is you have to allocate a certain amount for land, because land does not depreciate. So let's say 15%, it's a small amount. That's usually what it is. You're left with $850,000 of what's called your basis. That amount is going to be your tax write-off. Now, on your regular depreciation, if you were to divide that up by 27.5 years, you'd be getting about, just do the simple math, about $30,000 a year in a tax deduction. Okay, and that's great. That's just straight off your income tax. So cost segregation says like this: the engineer comes and identifies, let's say 20%, which is pretty average, of the building actually depreciates on faster rates. Okay, so 20% of $850,000, just simple math, about $170,000. Okay, $170,000 of extra depreciation deductions that now you can take in the first 5 years. So if you, instead of $30,000 of depreciation every single year, you now take 170 divided by 5, it's about an extra $55,000 or so, approximately. So you're talking about $85,000 of deductions instead of $30,000. So simple math, a very simplified version of that, but that's really how it works.
So if in simple ways, so if you, let's say, made that year, $200,000 in your job as a W-2, but then you have this property that you bought and you get this, $80,000 worth of depreciation, then you can deduct it from your earned income, right? So then you only pay taxes on the difference. Is that correct?
So not exactly. Not exactly. Not exactly. So here's how it works. So passive, real estate is considered passive income. Okay. Depreciation is considered what's called a passive deduction. Okay. Now there are really two categories when we talk about passive deductions. If you are an active real estate professional, you're put into one box. And if you're not an active real estate professional, you put it in another box. Generally speaking, the passive deductions can be used to offset the passive income. So from any of your real estate holdings, you can now use that depreciation or that extra depreciation, that accelerated depreciation, to offset all of that. However, if you're a real estate professional, you can now use that income, or excuse me, that depreciation deduction to now offset any income whatsoever. So that would apply to if you had a W-2 as well, or even if your spouse had a W-2, you can now use those depreciation to offset both of your income.
Amazing. Yes, and I heard about this just last weekend. I just didn't think about it. So let's go back to that. So if you are a real estate professional, then you can take all this deduction. But if you are not, then you can only deduct the income from the property.
You can deduct the depreciation, can offset the income from the properties.
The property only. Okay, so if you made $100,000 that year on the income of the property, then you can deduct these passive deductions from
Exactly.
the passive income.
Exactly. Perfect.
So is there kind of like a formula or an easy way to evaluate if a property that you own or based on the income of the property, if it's worth, because I know that cost segregation, you have to use a specialized company, so it has a cost. So when is there like a threshold when it's worth to go through this process to reap the rewards?
There's always going to be benefit, but kind of my rule of thumb is if you purchase it for over $1 million, it's a no-brainer. I mean, there's so much tax benefit there. Now, it does depend on more than anything on the purchase price of the building, because that's going to establish what that basis is. Again, how much you can actually write off. But it's also going to depend on, like you mentioned, your income, okay? Because if you don't have income from a property, let's say you bought vacant land, okay, or you bought a building that's going under, major renovations and there's no income, or your tenants aren't paying, whatever it is, right? You have no income, you don't need extra deductions that aren't going to be utilized, okay? Unless you are a real estate professional, and that can go to other uses. So my general rule of thumb, over $1 million, no-brainer. Under $500,000 usually doesn't make a lot of sense. It can in certain situations if you need it, but the price, the cost of the study, you have to look at what is the actual after-tax value, after-tax benefit, because again, these deductions are just offsetting your income tax. That's not creating, it's not giving you a refund. What that is lowering your tax liability, which is going to give you an after-tax, net value benefit from that. So that's kind of the rule of thumb I use. However, we always, our firm Madison SPECS, we always use, we give a free estimate, okay, upfront to show, even before you would to do it, to do a cost segregation study, just to show you what your potential tax savings would be. So you can see upfront already what you're even getting into. Right.
So let's say I would like to, I have a property and I am not sure if it's worth for me, my situation, because it's going to depend on anybody. Like every different person is going to be different. The same property could have a different effect on each one's taxes, right? So let's say what do I need to send to you in order to start this process? And I'm assuming that once you give me your recommendation, then I have to talk to my own accountant to see if that will help my situation.
Right, exactly. So the few things that we'll need are the address of the property. Really, our engineers will take a look at the property itself and be able to break down what the potential tax savings are going to be, what a cost segregation would come and do on such a property. So they're going to look at the address because they're going to pull public records and find out the unit count and the square footage, number of parking spaces, the unit breakdown, et cetera, the year it's built, all that information they'll need. But from usually we just need the address, the purchase price, which is going to, again, establish that basis, and the closing date of the property, when you actually purchased it, because that's also going to establish when your depreciation starts. It starts from the day you placed it in service. Usually that's going to be the day that you actually you bought it.
Okay, so I have a couple of questions here. So I know that, it starts when you put it in service, but I
Right.
think I also heard that you don't have to necessarily do it this year. Like if you don't do it in a couple of years, it could be retroactive. So you can apply those.
The cost segregation, you can actually do it retroactively, which means if you don't need, you don't take the tax deductions this year, you can retroactively next year, the year after, you can go back without even amending any tax returns. You can now go back and get those tax benefits that you missed, meaning get the accelerated depreciation that you missed in those first 2 years. And you can go back, even as far as 5-10 years, but in those years, you can now get those tax benefits, those extra deductions that you missed.
Oh, wow. So that is good. So if 1 year, like if you decide not to do it because this year is not worth it, but the next year you have a lot of income, then you can do it then, the cost
Exactly.
segregation on the second, third year, and then apply the benefits backwards.
You don't apply the benefits backwards because you don't have the tax liability backwards. But what you do
just
is
use all the benefits now.
You get those extra tax deductions that you could have taken then, you get to take them now.
Oh, okay. All right. So tell me about the bonus depreciation.
Bonus depreciation is an amazing part of the tax reform, the Tax Cuts and Jobs Act a couple of years ago, that allows for any property that was placed in service after a certain date in 2017 can now be eligible for 100% bonus depreciation. That means that it's an option. Once you do a cost segregation study and you establish what all those depreciation categories are, anything that depreciates or has a schedule under 20 years, okay, so that's everything that we're going to reallocate in a cost segregation study: 5-year property, which is personal property, and 15-year property, which is land improvements, okay, that's like landscaping and parking lot pavement, stuff like that. All those costs can now be taken in the first year as a first-year tax write-off. So instead of spreading it out over 5 years or 15 years, those extra tax deductions, you can actually now accelerate the entire amount into year number 1. So that's called 100% bonus depreciation, and that creates a huge, just incredible, huge, massive tax deduction. If you go back to our example of the $170,000 of extra tax deductions, you can now opt to take that all in the first year.
Wow. But you have to make a lot of money to make use of all that deduction too. So
exactly.
it gives you the flexibility to use it not that first year, right? It accumulates.
It carries forward.
Carries forward.
It means if you can't benefit from it, if you can't utilize it this year, you can carry it forward. You can use those deductions next year.
How long? Unlimited?
It carries forward indefinitely until they're used up, or until you sell the property, whichever comes first. Okay. When you sell the property, that now it gets released.
All right, and I just remember the question that I had in my head. So I was going to ask you, why does the price that you paid for the property counts? For example, like if you buy it at a discount and the property is worth more the day that you buy it, how does that affect the segregation?
So again, the depreciable basis, the amount that you can actually write off, is dependent solely on the purchase price. Okay, the amount that was spent. So even if you bought it totally discounted, unfortunately, you can't take a higher tax deduction on that. And even if you go and refinance the property in a couple of years.
That was my next question.
Exactly. It doesn't change. Right. So unfortunately, it doesn't change the original tax basis that you can now take as a write-off.
Okay.
On the flip side of that, the benefit, one of the main benefits is that, the IRS allows you to write off the entire value of your property over that amount of time, even if you didn't even put that money down, meaning you're financing the property. You're not paying out of pocket the entire $1 million, but you can now take $1 million write-off. And that goes to say as well as even if you got seller financing, for example. Let's say you didn't put any money down and the seller was financing it, but you bought it, you can now take the tax write-off starting from the day that you placed it in service when you bought it.
Wow. And you also mentioned renovations. So if you bought a property and you have a lot of CapEx, so you're putting a lot of money into it the first year, and then you don't have a lot of income, right? Because you've been spending this money. So there is no passive income that year. So I guess it just carries forward.
Yeah, correct. Now, there is something else that has to do with the renovations, which is that is the one case where your basis will actually change, okay? If it's discounted, that's not going to make a difference. If you refinance, it's not going to make a difference. But if you do renovations and you actually add more money into the property, that money that you're adding into remodeling or renovating the property now gets added to the basis, and that money, that amount, can now be depreciated as well, which means you can now take that as a tax write-off. And if you do a cost segregation on the amount of renovations, you can now accelerate that and take that as 100% bonus depreciation. So let's say, for example, you bought a property for $1 million and then you put another $500,000 into renovating it. Assuming the majority of that's not going into major structural components, it's going into maybe, let's say you're replacing the kitchens in all the units. Maybe you're retiling the floor, tearing out the carpeting and putting vinyl flooring. Let's say you're paving a new parking lot, right? All of those things are actually, those things that I mentioned are accelerated costs, which means you can now take the money spent on those assets and accelerate that, take those deductions earlier on.
Got you. Right. So all that money that you put in the business, you're kind of getting it back because you're offsetting your income and paying less taxes on that.
Exactly.
Got you. All right. That is amazing. So the bonus depreciation allows you to get 100%, right? That's what you said. Wow.
Yeah.
That's big.
It's huge.
Especially if you have a huge building.
Yeah, it's huge. So, I mean, a lot of people are taking advantage of this because it basically negates any possible tax liability that you would have whatsoever. And especially if you're a real estate professional and you have income from other sources, or your spouse's income from other sources, you can take all that massive deductions and use that to offset all of that income.
Wow. So what other advantages do you see? Because sometimes I hear investors using the cost segregation as part of their strategy to acquire buildings. Like they use it for the underwriting, like they count that, okay, we're going to do the cost segregation, and they use it in their numbers to work the numbers. Like, so they kind of calculated their returns and with the cost segregation in mind.
Right. So what they're doing when they're doing that is looking at not only what the NOI of the property, not only what the net operating income is going to be, but they're going to be looking at what the after-tax benefit is going to be, okay? Because the net operating income is showing you what your net, what the money that you're getting. Now, you're still going to have to pay taxes on that money, but if you can create a kind of schedule or create an Excel sheet that shows that money's coming into our pocket, that's cash. Yeah, we may have to pay a 35% income tax or whatever it is on that later on, but if I can show that all that's going to be extra depreciation is going to offset all that income, then all of that net operating income is literally its full cash flow, which then can then be used to reinvest, can be used to put back into the property, whatever it is. So that's really the advantage why people use it in underwriting, especially from a lending perspective. It can be beneficial when the lender wants to see what are your cash reserves, what's your cash flow, not just what's the NOI, because you still have to pay taxes on that. But if you could show, here's my real cash flow, that's actually might help increase your chances of getting a loan because you're showing that you have more income that's going to be coming in. Not necessarily more income, but more cash flow.
So let's say if you are an investor and you're investing in a syndication and you put $100,000 for the the purchase of a $10 million property. So you would be expecting, let's say, an 8% return on your $100,000. But now with this cost segregation, you could be expecting a better return, correct? Because the taxable income that you're getting, the passive income is going to be less, right?
Absolutely.
Wow.
Absolutely. The taxable income, I mean, the taxable income is definitely going to be less, and therefore it's going to compound your returns.
Right. Your
So
return is
definitely
going to
over,
be higher because of it.
exactly. The IRR is definitely going to be higher over the course of the ownership, for sure.
Okay. So what happens after the 27 years when you own the property? If you keep it, if you're a person that buys and holds.
Yeah. You know, if you're holding for 27 years, you know, more power to you, you know, God bless, and you should be great. The real benefit, you know, obviously, let's just even look at it a little more in depth. What happens after 5 years, right? We're taking these 5-year property and we're accelerating, you know, I mentioned before 20%, let's say, of the property into the first 5 years. What happens after 5 years? You're still holding it.
Right.
So what you've done is you've taken 20% of the depreciation and taken that all up front in the first year or the first 5 years. So from year 6 onwards, you're only going to be, you know, left with 80% of the depreciation, which is still going to be spread out every year over the 27 years. So in our example, instead of $30,000 a year, we moved it up to $85,000 a year for the first 5 years. And then if from year 6 onwards, instead of 30,000, it's going to drop down to about 25 or 26,000. That's basically how that works. After it's fully depreciated, 27 years, that's it. You're done. You no longer get those tax deductions. So the real, you know, beneficiary is going to be someone who's not just looking at a one property. You know, we're talking real estate investors who are looking at potentially buying several properties, buying every year, or, you know, several, you know, every year or every other year, whatever it is, continually creating income and creating those extra tax deductions to just kind of keep your income, you know, and increase that exponentially.
So you are compounding that deduction. Like if you keep buying one property and doing a cost segregation, you just continue that ball rolling, right? Because
Exactly.
you get a new deduction, and then the next year you buy another property, and then you get a new deduction. So your income is always going to be, your taxable income is always going to be less than what you are really producing.
Exactly. Exactly.
So
and in many, you know, many times less to none.
Yeah. Amazing. It's an amazing strategy. So also it kind of, you know, after your building is depreciated, it's not giving you any benefits tax-wise anymore, right? You can still have the cash flow, but now it's going to be a cash flow that is going to be taxable, right? All of it.
Exactly, which is why I mentioned that the reason why I mentioned that when you're looking at more than one property, again, the depreciation is not just per property. The depreciation comes to you as an individual, and those deductions can be used to offset all the income from all of your properties. Even if you're not a real estate professional, depreciation can offset any income from any property that you own. So, like I said, if you just have one property, that's it, you're stuck. You have depreciation with that. When it's done, you're done. But if you have more than one property, even if the depreciation runs out on property A, the depreciation from property B can now be used to offset that income still.
Right. Yeah. Yeah, that's true. So if you just have one property, you could also sell it once you have it all fully depreciated and then buy another one. If you don't want, if you're not an investor that is going to keep buying, but you could, you know, buy another one and then start depreciating that
Exactly.
one.
Exactly.
Awesome. Wow. This is mind blowing because you are making your income, your taxable income lower, which means that you are keeping more money. And then with that money, you can keep buying property. So it's giving you some extra power to keep buying more. And so if you keep compounding that, you know, it's super powerful.
Yeah, 100%. And it's unfortunately something that a lot of people don't know about, which is why I'm glad you invited me to share with your network, because it's something people really need to know about.
Yes. So how long does this process take?
It's, you know, from beginning to end, our process is, you know, really because just our volume. We were the biggest cost segregation company in the country, working in all 50 states. So we have a huge volume of work coming in. Usually takes between 6 to 8 weeks. And that's including the engineers coming to the property, coming back, producing, taking those findings, producing a report, reviewing it. It always gets reviewed at least 4 times, so we have an accounting team. It does that and then gets back to you, which it, produces this, 80, 90, 100-page report, which is very detailed. Really what it does is produces an updated depreciation schedule, which is going to show your accountant what you actually need to take those numbers and just put that into the tax return.
So it also gives you like a schedule of first year, second year, and so on.
Exactly.
Yeah. So this has to be an effort that has to be coordinated definitely with your accountant, because he's going to be doing your taxes.
100%.
Excellent. All right. Wow. This is amazing information, and I'm going to have to watch the video again and go slowly to sometimes it takes a little bit of time to understand certain stuff, so I'm gonna have to go back and listen again, but I think I understood everything.
Expert tips.
You forgot to mention on your bio that you are a super LinkedIn contact. You are on LinkedIn all the time and you know how to work it. So I wanted you to give me 3 expert tips on how to maximize your presence in LinkedIn.
Okay, great. So 3 tips, let's see. So I'd say, each one of these 3 tips may be broken down into a few sub tips. Of course. But I'd say the 3 most important tips are, number 1, be active. Okay, so make sure you're on there and consistent. Number 2, post as often as you can. So if that's every day or, a few times a week. And the 3rd most important thing, which is probably the most important thing, is engage with your audience. Engage with those people who engage with your posts, which means like their comments, respond to their comments, like other people's posts, respond, write great and engaging and thought-provoking comments on other people's posts. Actually, believe it or not, goes a lot further for your personal brand and for what LinkedIn can do for you than actually posting your own original content. So
would you say that it's better to focus on one platform versus going to different platforms, because you have limited time, right? So you don't have the time. I think most people don't have the time to be super engaged on every single platform. So I think in a way, it's probably better to just focus on one. So if you focus on LinkedIn or you focus on Facebook, depending on the on your goals, you should probably focus on just one. What do you think about that?
If you're gonna be personally involved in it, which I truly believe is the only way to really maximize the benefit of any social media platform, is if you're actually personally involved in it and creating that community, then yes, I think you're right. One platform is really the way to go, and put all your effort into that. However, there is still benefit in, many platforms, obviously, trying to test out other things, test out other waters. There's definitely going to be different audiences in those different platforms. I mean, just think about what I just said. If you're just going in one platform, there's a lot of other people who are just in that platform, which means if you branch out to other platforms, there are people that you would have never met or never been in contact with that are just in those platforms. So I can, there is benefit there, but you don't want it to get watered down. And unless you have a team and you have virtual assistants and you have, you run a marketing firm, like Gary Vee, he's pushing all the time, like every social media platform, and just put it out there and post it 100 times a day across all platforms. Yeah, because he has a whole team of people right behind him that are doing it for him, and and helping creating that content. So you can't spread yourself too thin, because what you're ending up doing is not getting really any benefit from any platform.
Yeah, I definitely participated in one of your challenges, and I could see the difference. Like before that challenge, I really didn't use LinkedIn at all. I created an account like 10 years ago, maybe 15
Right.
years ago when LinkedIn
Mm-hmm.
started, and I just put my bio there. And, every once in a while I get the happy birthday, happy anniversary, and somebody trying to hire me. But I really didn't use it at all until this year. And once I participated in your challenge, I see you there all the time. Like your posts have a lot of engagement, and so I can see how you know how to work on LinkedIn. It's amazing to see your posts and your engagement.
Well, thank you. Yeah, it's, and it just comes from just the experience and just trial and error. And like I said, the first thing, just consistency, just being there every day, showing up and engaging with people. And it kind of builds on itself.
Absolutely. Yonah, thank you so much for being with me on the show. I have so much to think about right now, and I need to get that property analyzed and see if it will work for me. Where can people find you? We know I mentioned LinkedIn, but where are other places where people can find you?
That's the main place. I'm on Facebook also, but if you want to find me, that's a bigger pocket. It's also a great platform, pretty active there. But yeah, LinkedIn is the best place to find me.
Absolutely. If you go to LinkedIn, you are going to see Yonah. Thank you so much. Thank you for taking the time, and bye-bye, everybody.
Thank you, Anette.
This was Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.